The US dollar holds a uniquely influential position in the global financial system, significantly shaping global trade, international debt markets, and central bank reserve management. Traders and investors alike closely track the dollar's performance, commonly measured by the dollar index, DXY, as it has profound implications across asset classes from emerging markets to commodities like gold. Firstly, the dollar's dominance in global trade is unmistakable. Approximately 80% of international trade transactions are invoiced in dollars, making it the primary currency for global commerce. This widespread use means that fluctuations in the dollar's value can dramatically impact global trade flows, profitability for multinational corporations, and the economic stability of trade-dependent economies. A stronger dollar generally makes for exports from emerging markets more expensive, potentially reducing demand and impacting economic growth. Secondly, the role of the US dollar in global debt markets is significant. Many countries and corporations issue debt denominated in US dollars, taking advantage of the dollar's stability and broad acceptance. This extensive reliance on dollar-denominated debt exposes borrowers to significant risks, particularly during periods when the dollar strengthens. Rising dollar values can make repayment more challenging, increasing the likelihood of defaults, particularly in emerging markets. As a result, traders closely monitor dollar trends when evaluating risks associated with international credit markets. Central banks worldwide hold substantial reserves in US dollars, underscoring the currency's pivotal role in global financial stability. The dollar typically comprises over 60% of global foreign exchange reserves, highlighting its function as the primary reserve currency. Central banks often accumulate or reduce dollar reserves in response to economic conditions or currency stabilization efforts, directly influencing global liquidity and exchange rate dynamics. The dollar index, DXY, which measures the dollar's value against a basket of major currencies, is a critical indicator for traders. Movements in the DXY can signal broader economic trends influencing market sentiment across asset classes. For instance, a rising DXY usually pressures commodities like gold as it becomes more expensive for international buyers using other currencies. Conversely, a weakening DXY typically boosts gold prices and supports commodity markets as commodities priced in dollars become relatively cheaper. Emerging market assets are particularly sensitive to DXY fluctuations. A strengthening dollar can lead to capital outflows from emerging markets, heightened volatility, and weakening currencies. Conversely, a weaker dollar typically supports risk assets and encourages capital inflows into emerging economies. In summary, understanding the multifaceted role of the US dollar and closely monitoring indicators like the DXY is essential for traders. Recognizing how dollar movements impact global trade, debt markets, reserve management, commodities, and emerging markets enables traders to anticipate market trends, effectively manage risk, and seize trading opportunities in the complex landscape of global finance.